Hello and welcome to BQ Prime. I am Miral Dadia, and it's a season of mergers in the financial space. We have been discussing about the HDFC twins, and post the announcement dates, you already have a HDFC Bank which is trading at life high levels, as well as HDFC which has hit a 52-week high in today's trading session. Joining us on the show to discuss more in terms of what's in store for the merged entity, Deepak Shenoy, founder at Capitalmind, joins in. Deepak, good morning and welcome to the show.
Thanks, Hiral. Great to have you here, and thank you for having me on your show.
Always a pleasure to speak to you. Deepak, my first question coming to you is, whenever we talk about these mergers, acquisitions, and specifically in the listed space, the key question is in terms of the arbitrage opportunity that comes out of it, right? Now, HDFC, that's almost over. The next big thing that we are talking about is what is in store for the merged entity. Most of the analysts that we've spoken to are baking in loan growth and EPS to be in that range of around 17 to 18% with regards to FY24. How are you looking at it, and what's your estimation?
So, I think the problem with HDFC Bank merger is there's a part of the loan book that cannot grow, the land loan book, because HDFC was one of the largest lenders against land, and banks can't lend against land. So that part of the loan book won't grow at all. The second one is parts of the EPS growth were coming in for HDFC from HDFC Bank's dividend. Which won't happen anymore. So that complication kind of merges in a different way. There is also some equity dilution that will happen because of warrant conversions, very small, and that might dilute your EPS growth less than the actual loan and operating profit growth before provisions. But I don't think the growth in terms of earnings will be much in the next year. There will be a lot of issues with respect to them building a priority sector loan book because they get 3 years to do that. They have to change their deposit. So the deposit effective borrowing cost for the merged entity will be higher than HDFC Bank standalone because HDFC Bank largely borrows from retail deposits, whereas HDFC had a large amount of wholesale deposits, bonds that they would be taking money from. So I think that complication will keep their margin growth relatively low and also their overall EPS growth down to 13%. Loan growth should be 16, 17 given how strong the economic trends are. And the market itself, the whole banking sector itself is growing credit at about 15 to 16% right now. So, getting 17% loan growth itself from the merged entity is probably not going to be a big problem.
Right. So that's with regards to where the loan growth goes. Now, you mentioned about the margins as well. Uh, are you expecting, initial moderation to come in terms of the net interest margins? And this is, and from there, we see some bit of an uptick, but it'll be pretty much range bound. What's your view?
So I'd say right now you'd see the net interest margins compress a little bit simply because of the way the merger things are. A lot of things will happen inside the bank, right? So because the banks will have to merge the bank and the NBFC have to merge their offices. There will be a problem in HR itself, the seniority of posts in different organizations. Obviously, the bank will take precedence. So senior people in HDFC will have time adjusting. Some of them, there may be attrition. There'll be that weakness in that process. You're going to see some kind of a slowdown in the form of loan growth itself. The other banks are also hot on their heels. So I think that way there will be some pressure in terms of both deposit rates. There will be some pressure in terms of loan rates itself. So I would expect NIMs to come down for the next 2 or 3 quarters once the merger is done. But over time, this is a much larger entity, so I'm sure they will come and find their mojo back in terms of building up their NIMs. India generally has very high NIMs in banks, so I think we deserve much lower NIMs. So I hope RBI opens the door to many more banks to come in because of so many banks are merging and forming larger entities. We should have more competition from other banks to come and reduce NIMs, reduce effective loan rates and increase deposit rates therefore. So longer term trend, I'd be negative but on NIMs in general, but I think HDFC will come back to normalization in maybe a year or so.
Right. Deepak, from an operating leverage perspective, now as HDFC Bank actually exits the investment cycle, you talk about productivity, you talk about the cross-selling opportunities that improve. How do you expect the cost ratios to perform, over the next couple of years?
So I think we haven't done too much of an analysis on this, and one of the problems is rooted in banks tend to both cross sell and perhaps some in some ways miss sell as well, and a large amount of growth in the last few years has happened from a large amount of mis selling as well. I'm not saying that any particular bank does it. I think all banks do it. There is that pressure that comes into to sell. So some part of the knowledge boom that is happening in people getting more aware of these cross sell, which crosses over into miss sell kind of opportunities, will curb some of the cross sell opportunities at the banking level. Competition from private and maybe smaller players has increased opportunities for customers to diverge away from banks as a primary source of their investing knowledge and so on. So there'll be that much lesser in those areas. But I think in general, while the bank is not, I mean, the merged entity is not very efficient right now. HDFC employees don't sell mutual funds and don't sell other stuff, right? So they're going to have to be forced to do that going forward. So after the first level of training, I would say more cross-selling opportunities arise, maybe after a year. So I would expect all of that to start happening only after the next year, moderate a little bit by the general prevalence of more knowledge, more open source ecosystem in terms of either an account aggregator or some of the other things, which will allow technology to kind of butt into their customer reach as well.
Right. So that's all from a fundamental perspective. Now, if you talk about valuations, right? Clearly, you have a HDFC Bank which is trading at a discount to its historical mean, at least. So, would you say that it is available at an attractive valuation at the current market price? Number one. Once we get there, we'll talk about the future valuation as well.
So I think from the perspective of a bank, I think the lower valuation reflects the lack of clarity on what happens after the merger, how much there will be a problem in A, attrition, B, growth, B, three, C, margins. We don't know that number, so there'll be a lower valuation for a while, and eventually, if they show that they're actually not affected and start growing properly, I think we will see in the emergence of relatively higher P ratios. So if you look at it from a price to book perspective, HDFC is still very richly valued. Over the long term, as banks get mature and the economies get mature, you don't pay this kind of a price to book for a bank. So I would say the moderation has already probably started to set in. They are still undervalued compared to maybe their competing private sector banks, but that also reflects a moderation in the growth expected in over the next 1.5 years. I won't say attractive, but I think it's a better valuation than earlier. Once the troubles ease out, I think you'll find that the bank, if it starts to show the level of growth that we're talking about, 15-16% over the longer term, then this valuation is reasonable and makes sense for a large cap investment. Having said that, all valuations are relative. I think there are other things that are relatively even more valuable than HDFC Bank, even in the financial space, simply because either they're growing faster and better, or that they have a better proposition for getting more margins. So relatively, I would say attractive only at a comparison to its own historical values, but not so much in comparison with the rest of the industry.
Right. And when you mentioned about peers as well, let's pick up two, major private sector banks, which is HDFC Bank as well as ICICI Bank, right? How are you seeing the valuation gap between both of them? Because clearly ICICI Bank has outperformed the sector, where we've seen an improvement with regards to the credit quality as well as growth across verticals. And the valuation gap between a HDFC Bank and ICICI has narrowed significantly, right? Do you think there is a possibility of that gap widening from here on? Probably, if an HDFC Bank becomes a re-rating candidate as well, from the next 1 year perspective?
So we own ICICI, so biased in that perspective. We don't own HDFC Bank or HDFC. We own, well, there's parts of it in some portfolios, but that's for a different reason. There is a significant retail exposure at the HDFC Bank level compared to the retail exposure at ICICI Bank level, or in fact many other banks at that point. I think their largest exposure they have the largest retail loan exposure in a way, and a lot of it is unsecured loans. So it's not secured. Like ICICI Bank does do personal loans, but a lot of it is lending against homes, which are secured. So I would say I think ICICI is more attractive because it has relatively better lending in general as a book. And while we've always considered retail to be a good loan book, I think the next few years are going to show us how much stress there is going to be in retail loans. This changes, perspective. So HDFC should be valued, I think, at a slight bit lower than ICICI Bank because of that stress that is likely to appear in retail loan books. Though the combined entity has honestly a better and more secured loan book. So you might see some re-rating from that perspective, but HDFC is still valued at a richer level in many ways. And I would say the levers that allow HDFC to grow are probably less valuable than the levers that allow ICICI Bank to grow at this point. So I don't think the spread will widen. It may narrow actually in the next year.
Right. So that's with regards to valuation between HDFC as well as ICICI Bank. But moving on, as we discussed that, this is a season of mergers that we're staring at. Another one in the making has been, the IDFC twins. Clearly, this will be one of the second major deals in the financial space. And clearly, the markets did get a whiff of the same as well, because you had IDFC, which surged to a 52-week high in trade in yesterday's session. Good moves coming in today as well. Firstly, Deepak, your thoughts with regards to the merger?
So the merger has been a long time coming. If you remember, IDFC was allowed to launch a bank way back when two banks were given licenses, Bandhan and IDFC. Bandhan actually converted to a bank. So every bank, when it starts off, has to have a promoter. That promoter has to own 40% of the bank for 5 years. IDFC owned, this much percentage of the bank for a long time. And after these 5 years, after the time that the bank has been listed, it's been 5 years and so on, RBI allows the promoter to reduce their stake. And there's been a lot of discussion on whether the promoter should not have, all this stuff. But over time, they need to reduce their stake down to, I think, the 10% levels and all that stuff. So the best thing for an IDFC company, which has no operations really, it has just owned a mutual fund and a bunch of other assets, they sold all those assets. That asset sale to Bandhan happened in January. I think they sold their mutual fund to Bandhan. So that gave them about 4,500 crores in one of their subsidiaries, which will eventually merge back into the bank itself. This process has been long, forthcoming. They've had to get permissions from RBI. RBI was not keen to give a lot of permissions early on. They eventually did give the permissions. Equitas was the first to merge. IDFC is the second. Ujjivan will eventually happen as well. And these promoter entities, which were just non-operating holding companies, which are also listed, it makes no sense to have them listed, and eventually you have to merge them with the bank itself. So that permission is being given right now. IDFC shareholders are currently at about a 9% premium. That means if you buy IDFC and then wait for the merger, you'll make 9% if IDFC Bank were to trade at the same point. But that's also because it's about a year away. You're going to go through NCLT, RBI, a bunch of others for permissions. Once all those permissions have been received, it's only then that the merger will happen. So it could take 15 to 18 months.
Right. So overall, Deepak, my last question on this one is, as you mentioned about, the merger ratio, it clearly favors IDFC shareholders, as you mentioned, and we are seeing a 9% premium as of today. Taking the 12 to 18 month timeline into consideration, would it be a good investment taking the 9% into consideration?
So I think a large amount of it depends on, so unless you do an arbitrage where you hedge, you buy IDFC short and IDFC Bank, short IDFC Bank, that would give you the merger arbitrage of 9% whenever it happens. So the problem is your capital is locked till that time. So you'll have to keep your capital made available till the actual merger happens. And during this time, the difference can actually widen. We've seen this in Ujjivan, we've seen this in Equitas, where what was 8% became 15% before it went back to zero. I mean, the zero is when the merger actually happens, right? So some of these ratios could also change. Let's say RBI came back and said, you can't do this. You need to give so many more shares or something like that. So they might have to change the merger ratios at some point. So there is some uncertainty around that. So yeah, it's a good investment if you're a merger arbitrage person, if it makes sense for your cost of capital. But 9% is not going to cut it for most people. But on the other hand, is the bank fundamentally a better story or IDFC? I think the story has to come from the core underlying earnings itself. If they can benefit from the growing economy in a better way, if the fear around whatever is happening with Vodafone, because they have some exposure to Vodafone, goes away, I think this bank can actually have good returns in the longer term as well. The returns have been fantastic for the last 1.5 years. So, they have to live up to those expectations in terms of financials as well.
Absolutely. So I think it's going to be interesting to see how all of this pans out as well. Thank you, Deepak, so much for joining us on the show and sharing the views, your views with regards to the HDFC twins, as well as what the valuations would mean, and now a new one in the offing, which is the IDFC twins, which will be merging over the next 12 to 18 months. Thank you. Stay safe and speak to you soon again. That's all that we have on this edition with regards to where we've discussed the banking mergers so far that are in the making, but clearly lots brewing in the financial space as well. In fact, we will you can tune into BQ Prime. We will solve all your queries that you have with regards to the HDFC merger with Chakri Lokpriya at 12 noon. Thank you.